regard investing as a type of sport or entertainment. The media encourages this way of thinking as they sagely report on the daily gyrations in the share markets with the wonderful benefit of hindsight. I've previously addressed the media's love affair with residential property when we examined the sale of Ray Martin's Coolum property. A number of my retired friends and acquaintances, when asked how they are allocating increased spare time, tell me that managing their investment portfolios and keeping up to date with market developments keeps them busy. For them, investing is an interest or a hobby. As a source of mental stimulation and entertainment, that's great. But an often unstated rationale is a belief that they are or will become skillful enough to outperform the market. That is, they are or will be above average investors. In FinHealth's view, they're deluding themselves. Any apparent success they or any other investor may have is more likely due to taking higher risk than appreciated and or dumb luck. Genuine investment skill is both extremely rare and hard to reliably identify. In the rest of this video, we'll examine some poor investment practices that those who consider investing as a sport, entertainment and or a hobby often exhibit. These practices increase the likelihood that the investor will underperform a less exciting, relatively passive approach to investment that is implicit in the FinHealth approach to personal finance. Hi, I'm John Lesky, recently retired personal financial advisor and founder of FinHealth, a tool to guide you to your financial independence. If you regard investing as a hobby, sport and or source of entertainment, you're likely to exhibit at least 3 behaviours or practices that are potentially detrimental to your investment performance. They are 1. Overactivity, 2. A lack of investment diversity, and 3. An emotional attachment to your investment decisions. We'll briefly discuss each in turn. First, overactivity. A sport, entertainment or hobby isn't much fun if you're hardly ever doing anything except maybe observing. With investment, the temptation is to endlessly tinker with your portfolio, to pursue the next big thing or respond to a hot tip. All this activity comes with inevitable transaction costs that are avoided with a more passive approach. However, higher returns on average are unlikely. Transparent and liquid investment markets, such as share markets worldwide, are pretty effective at quickly incorporating all available public information into current prices. The only way an individual investor is likely to beat the market is if they have inside information, that is, information not known to the market. And even this doesn't guarantee success. Another form of overactivity is timing the market, that is, moving into and out of asset classes or individual investments based on a forecast that they are about to rise or fall. While I'm not aware of any evidence that this can be reliably pulled off, a certainty is that higher transaction costs will be incurred. It may also crystallise capital gains and taxation obligations. Market timing is also more decision intensive than a passive buy and hold approach. For example, a decision to exit the share market because you believe it's going to fall may also require a decision to re-enter the market at some stage. While your exit decision may prove correct in the short term, you may find yourself out of the market if it subsequently rises strongly. I recall a just retired friend of mine bragging that he was 100% in defensive assets at the time of the global financial crisis. 12 years later, he was still 100% in defensive assets, totally missing a large rise in share markets and having to revise downwards his lifestyle expectations. There are always apparently good reasons not to commit at least a proportion of his portfolio to growth assets. Our next poor practice is a lack of investment diversity. If you're going to win at investing, that is, do better than a passive index approach, which approximately mirrors asset class performance, you've got to take bets. For example, if you're investing in the Australian share market, you would concentrate your holdings in a limited number of shares, that is, the expected winners, rather than hold all or virtually all the market. The Investment Diversification Ratio article discusses the benefits of investment diversification, often described as the only free lunch in finance. In summary, it explains that a failure to diversify as broadly as cost-effectively possible offers no expected additional return, but comes at the expense of higher risk in terms of investment volatility. While a concentrated bet in a particular asset class, for example, Australian shares, may see you outperform, you're just as, or more likely, to underperform. And, generally, you still pay a premium regardless. Witness the recent performance of former market darling, the Magellan Global Fund. Taking bets that don't have an expected premium return aren't part of the FinHealth approach to achieving good financial health. Finally, let's look at emotional attachment. If you see investment as a hobby, sport, or entertainment, and individually choose each investment you hold, in contrast to buying funds that mirror asset class performance, it's highly likely you have some emotional attachment to those investments. They're your hand-picked babies. It's going to be hard to admit that sometimes you'll make poor decisions. Your ego may prevent you from taking appropriate action in a timely manner. Also, behavioural scientists have shown that we overvalue things we choose to own, compared with an objective third-party assessment. Therefore, you're likely to consider that your investment in a particular share or residential investment property is worth more than others are willing to pay. Emotional attachment clouds your decision making. I remember, as a financial planner a number of years ago, discussing a potential client's overexposure to residential property. I canvassed the idea of selling a particular apartment to reduce their massive investment risk. This was not met favourably by the couple, with the wife saying, and I quote, "I'm very fond of that apartment." Emotion trumps logic and a sound investment strategy every time. Contrast that with owning a highly diversified, market-weighted international share fund that may hold more than 5,000 shares. Apple Incorporated, for example, may only account for about 1% of that fund. Buying or selling such a fund to achieve a desired asset allocation is a mechanical task that involves no ego or emotional attachment. According to economists, the purpose of investing, or more correctly saving, is to forgo spending now to enable increased spending in the future. How much you save depends on the satisfaction you expect to receive from current spending versus future spending. It's a pretty cold, matter-of-fact proposition. The FinHealth approach to personal financial planning has a similar notion in mind. You invest today in order to be able to afford your desired future lifestyle. It advocates a focus on understanding that desired lifestyle and the resources expected to be available to achieve it. When it comes to investing cash surpluses, we think you should do it in a way that's most likely to achieve the desired result. This requires that you meet or exceed the benchmarks for the 3 FinHealth indicators of financial independence that are directly focused on investment behaviours. That is, 1, the tax effectiveness ratio, which examines the question, are your investments held tax effectively? 2, the growth asset allocation ratio, looking at how much investment risk are you comfortable with? And 3, the investment diversification ratio that considers, have you too many investment eggs in one basket? The investments chosen should simply be seen as the most efficient means to an end, financing your desired future lifestyle. There is no place for overactivity, investment concentration, or emotional attachment to any investment. This approach is boring, but it's effective. It's the sporting equivalent of playing par golf. For most, a focus on investment that aims to reliably achieve the equivalent of subpar golf is a futile endeavour. We'd suggest they should find another sport or hobby that is less likely to handicap achievement of the financial future they want. Hopefully, you found this video of interest. I'd like to know what you think. Please provide any comments or questions below. And finally, thanks for watching.